Okay, welcome everybody to episode 55 of the Volatility Barometer. So I was a little bit frantic here. It just occurred to me that I didn't actually send out the email letting the community know that we're doing a live stream. It went out to the private community, but the extended public newsletter that has, several thousand people's names on it, it actually didn't go out. So actually, this probably will be a decent thing if you're here watching. You can start putting your questions in the chat section, and it'll probably mean that we'll have a little bit more time to get to your questions because it's possible there won't be that many people here today. So we're going to do it anyway. You can always catch it on the rebroadcast. You don't actually have to be here live. It's probably better. You can get your questions answered. But while we're waiting for a few more people to roll in, I just wanted to give a special shout out to my wife, who actually we've been together for 13 years. First 12 years that we were together, she never golfed. I'm a former professional golfer. She never played even once. And then last year she started to play, and she's played a lot. She's been working really hard. And today was kind of a special day for her. I don't know if you can see this scorecard. It's absolutely beautiful. But if you look down here, she actually broke 100 for the first time, which is a huge milestone if you understand golf, if you are a golfer. Getting that under 100, and I'm very strict. So, as far as the rules, I count all the water shots, I count all the sand. The 16th hole, she hit 2 balls in the water, and I counted both of them. 17th hole, she hit 3 bunker shots in the same bunker. I counted all of them. So I am quite strict with the rules, but good job to my wife. I'm super proud of her. 97, so she finally did it. Kind of relax a little bit from here on out, and the next milestone will be under 90. So good job, super proud of her. Just wanted to mention that real quick. So don't forget to sign up for your free trial to VTS. You obviously no obligation to stick around, but if you're ever curious about what we do in our private community, of course you can sign up for the 2-week trial. You'll see plenty of trades, and you'll be able to see the volatility barometer and the dashboard, and you'll have a pretty good idea of what we do. And then from there, of course, the decision is yours. But give the video a like for me if you'd be so kind. Subscribe to the channel. We're closing in on 25,000 here, so that would be very helpful. And let's get into things. Okay, so you can see the rundown here. First of all, I am going to review the VXX stuff. There was finally a reverse split. I know a lot of people were waiting for this for a long time. We are still waiting for UVXY to do the same thing, but we will talk about a little bit of the split stuff. We've done this before because, of course, this is number 7 for the VXX. This is not new. It'll happen again in the future, but we'll go through that. And then I think something that's a little bit more fun, that you might actually learn something about how these products decay over time, how to predict them. We're actually going to try to calculate exactly when in the future the next reverse split for VXX will be. So that's always fun. We absolutely nailed our last prediction. I did this same thing about 2 years ago. We got it within 2 weeks. So I'll highlight that. And then, of course, live Q&A. So you can start putting your questions in the comment there, and we will circle back to it. So let me find my spreadsheet here. These are notes. These are basically mostly just for me. Let me move a few of these windows out of the way. Apologies. All right. Everything looks good. Yeah, these are just for me, but it's just to keep my thoughts in order. So let's get right into it. So, of course, the VXX did do a 1-to-4 reverse split officially March 7th, 2023. A couple of days ago, it happened on Wednesday. So basically, split history, we can check it out just in case you're not aware. Like I said, this is number 7. This happens quite a bit. Here's the UVXY. It's actually happened 10 times because that is a leveraged product. But this is the 7th one for the VXX. So if we check the average, we can see that it typically, of course, it bounces around a little, but the average is around 10.99. So that's when they would be looking to do the 1-to-4 reverse split, which they have all been in the past. And essentially it happened. It has come and gone. And the big question is, does it even matter? I mean, what actually happened? So the first thing is, why do we actually have to do these? So some of this you probably know, especially if you're on my live streams, you probably are aware of this, but it is never hurts to actually go through it. So as we know, the volatility ETFs, VXX specifically, tracks the front 2 months of the VIX futures. This is VIXCentral.com, great website. Bookmark this, you'll check back often, I'm sure. So it tracks the front 2 months of the VIX futures. And actually, more specifically, it tracks an underlying index. Remember, buying and selling on the actual product of the VXX doesn't do anything to the price. It's tracking an underlying index. This is the SPVIX STR index. It's basically a short front 2 month VIX futures product. Whatever this does, the VXX does. So we actually have to reverse split this because what we know about this product is, I'll show you a long-term chart here, bear with me, and it'll hit you right away. You'll know why they have to do these reverse splits so repeatedly. So this, come on beach ball, my spreadsheets do this sometimes. There it is. So the VXX is this one right here. This is a long-term chart, looks pretty ugly. Obviously the trend is down. Hopefully everybody can see that. There's all the splits marked on there. So why does it have to do this? Well, essentially, because this is an inverse product and it is tracking the front 2 months of the VIX futures, whatever those futures are doing, that's actually going to be causing some of this movement. So it's actually not contango and backwardation. What a lot of people think, sorry, I'm clicking around a little bit here. What a lot of people think is that this is a situation called contango, when the back month is higher than the front month. You can see it down here, percent contango. It's small, but it is still positive. A lot of people think that that's actually the important part because you hear it said so much. What's actually important is where these two futures are in relation to the VIX index, which is this green line. That's called roll yield, and that's really what we're looking for. So right now, even though it is in contango, you can see the roll yield is negative because the futures are below the VIX index. So if this situation persisted for an extended period of time, the VXX would actually go upward, right? But that's not always what's happening. You can actually see the long-term chart here. The average roll yield is this bracket here, 8.24%, significantly positive. And we can see the percent of rolling positive days of roll yield, 82% of the time, this thing is actually positive. So when you get a situation where really, aside from a few bad periods along the way, most of the time the VXX is going to be decaying downward. This is why there's so much pressure on it going down, is because there's, 82% of the time it's positive roll yield and it is just slowly decaying. It's acting as an insurance product. Of course it's going to go down. If it didn't go down, then everybody would hedge their portfolio and the markets wouldn't make any sense. So of course it's going to go down. That's why they have done all these splits and they will continue to do these splits through time. Now, depending on how the market moves around, of course, from 2017 until 2021, that's a pretty long period of time with no splits, but that's because you had, of course, the Volpocalypse in 2018, Q4 2018, 2020 during the COVID stuff, 2022 was a rotten year. So, of course, there's only one split there. You can go extended periods, but the long-term trend is, of course, down, and that's going to continue. The question is, does it matter? And the short answer is, of course, no. Most of you probably know that, but I'm going to rip through this really quickly. So essentially what happens with the reverse split is it's a 1 to 4. So if it splits at 10, just for easy math, all that's going to happen is the price goes from 10 to 40, and then the share count is divided by 4. The only thing you have to worry about, of course, it's done at a net zero cost. If you were holding the ETF, you didn't lose any money, of course. You just wake up the next day, your net liquidation value is exactly the same. It just looks a little bit different. The only thing that sometimes throws people is partial shares. So let's say you had at 101, for example. Sorry. Out golfing today, I have heat strokes, so bear with me. Let's say that you were holding it at 101. If you divide by 4, of course, that's 25.25. You can't actually have a partial share. So all that's going to happen, they're not going to steal your 0.25. They're just going to cash settle that, and you're going to have 25 shares valued at 40. Basically, nothing is happening. The next question, what about options? It's the same thing. Nothing is happening. No value is changing here. Nothing happens. The only difference is with options, of course, you really can't deal with partial contracts. So if you look here, this is the VXX string. What ends up happening is they basically temporarily remark some of these with this 25 over 100. Essentially, these are the old options. Anything that says 100, this is the market makers creating a new option string. And that, if you go into them, you can see the prices are pretty high, right? 39, 41. The price right now is 53. So this is a new string just created a few days ago. These ones that say 25 over 100, look at the prices here. These are still low. This is still the old price divided by 1/4, of course, because that's the reverse split. So all that happens is, again, contracts are divided up and it's marked against a different thing, but no value has been lost. So that's very important for people to understand, that a reverse split doesn't create or destroy any value at all. It is just something that, aside from a few things that we'll get into here, it largely comes and goes. Now, I will say, and one thing that often comes up, there is one very important thing that you need to understand. With option trading, if you have options open with these old contracts, now would be a good time, and actually probably at the split or before it, you'd probably want to wind those down and reestablish positions with the new 100 contracts, anything that says 100 next to it. Because the liquidity could dry up quickly, you will lose the ability to open new shares, and your option is basically limited from that point forward. The value should be the same. It is the same, but again, just best practices. You probably want to shut these down. You can actually see that I have a position open. You can see that here. This is a VXX Butterfly. The only reason that I didn't close it is because these temporary trades, they're very short dated, and I only have to close this. I don't have to do any adjustments at all. I don't have to move it around. I basically only have to close this leg if, well, the price is way over here because the last 2 days, but actually on the split day, it was looking like a really good trade. I would only ever have to close this one and maybe this one, right? So I just left it open for an extra couple of days, no big deal. But if you had something longer term, like let's say you had this one, or maybe even longer dated, like 70 days out, those are the ones that you'd want to shut them down, reestablish something, same expiration, they will be provided, and within a couple of days, the liquidity will pick up. You can see there's some action there already. It's gonna get pretty good within a couple of days. So just best practices, you want to shut your trades down and go ahead and do that. So really, that's a long way of saying the only thing that a reverse split does is it helps us out a little bit as option traders, because of course the difference between say $10 and $9 is a lot worse than the difference between 50 and 49. So when you get that 1 to 4 and the VXX goes from 10 to 40 and now 50 because of the market, this is just better for us. If we're trading butterflies, if you're trading iron condors, you can actually have a lot more strikes to choose from. So it's good for us. No value changed hands. Just remember, don't leave those options open too long after the split. They're kind of dead in the water, so just close them down, reestablish. It's all good. No problem at all. So now let's actually get into some calculation. All right, so data corner, we always dive into a chart or a graph or, a data set and try to unpack it and get to some answers. So I thought today might be a good day since we have done the reverse split. Let's go ahead and let's do a screen share. Let's definitely remember to do that. And let's actually calculate when this thing is going to do the next reverse split. So what was actually interesting is we nailed it completely last time. I did a live stream on August 2021 where we tried to predict when the next reverse split would be. And I've got a little maybe 1 minute clip here that I can play for you. Let's see when $10 is. When is this actually going to happen? So it's going to breach below 10, 406 trading days from today. Easier probably to go monthly, 19 months plus 7 trading days. So 19 months plus 7 trading days from now, we are expecting the VXX to be $10, right about there. So what would that be? Right now it is August 14th. We're looking at 2023. So March 14th, and then we're going to add 7 trading days to that. 5, 6, 7. 24th of March, 2023. So let's write that down. VXX at 10 on March 24th, 2023. That's when we're expecting, based on long-term decay factors, that the VXX will once again... All right, you get the point. So Essentially, we've done this. Oh, sorry, didn't bring my mic back. We've done this already, and we're going to go through it again. But I just left it open. There it is. Our last prediction from 2 years ago was March 24th, 2023. And the VXX actually split on March 7th, 2023. So we missed it by a couple of weeks. But I say we pretty much nailed it almost exactly. 2 years out, that is actually a pretty good calculation. So how are we going to do this? Well, what do we need in order to calculate this? You can all do this yourself, no problem at all. But if you watch me do it, you'll actually see a few things about the decay path and all these things. So, you know, I like doing these things. I think it's a good exercise. So basically, we need to know the reverse split price on average. Remember, it varies a little bit. We can only ballpark it, but around $10.99. And then we just need to know the decay factor of VXX long term, and we can plot it on a graph, and then we can figure out when it's going to cross that $10.99 into the future. This last part, I'm going to get to that in a minute. Does this prediction actually matter? Can we actually put a trade on that will capitalize if we are correct? So $10.99 is the first thing. The second thing is the VXX decay factors, which you can see right here on a one-day time frame. This is going back to 2004. So I've used the VIX futures. Remember, VXX launched in 2009. So we've extrapolated backwards what VXX pricing would have been, because all we need for that is the VIX futures, which did launch in March of 2004. So this is the VXX. This is a geometric decay factor over 1 day of minus 0.249%. So 0.25% per day on average is what the VXX decays. Now, of course, it goes through massive spikes, big crushes. It can go much worse than this. It can go much higher than this. This isn't something that you want to just blindly short, of course, because it can go several 100% on you, and you could get in a lot of trouble if you're short. So you need a sophisticated strategy with good risk management. But long term, that's what it is over 1 day. Here's 5 days, basically 1 week, so you can just remember that. VXX on average decays about 1.24% per week. And then there's 21 trading days in a month. It decays on average, again, geometrically going down 4.5% per month. So with that simple number, now all we have to do is put it into here. So I'm going to use the decay factors. We will check what the VXX is today, 54.19. So I'm going to actually do all three of these. 54.19. My spreadsheet's going to beach ball. And then make sure that 1 day, 5 day, that's that one. 21 day is that one. We are good to go. Let's update this. You can see the beach ball there. Awesome stuff. I hate my spreadsheets are so big. When you ever do the auto calculate, it takes a few seconds to actually think about it. But this is what we're looking at. So all we have to do now is look where it's going to cross that 10.99. It's going to be right there, about 644 trading days. So let's go down. Let's find where there's 10.99 right there. 640 trading days from now. It's always easier to use the monthly. So 30 months and what is that? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Hopefully I counted right. That looks like 10 trading days. 30 months and 10 trading days. So right now is March 10th, 2023. So we are looking at March 2025 plus 6 months. April, May, June, July, August, September 10th, and then add 10 trading days. We are actually looking at September 10th, 2025. The VXX should cross below 10.99. Of course, we could do the same thing for UVXY. It's just a different decay factor. Of course, it's leveraged, so it decays a little bit faster. If you want to see the monthly, 8.5% per month for the UVXY. But for the VXX, very easy to do. This is the long-term decay factor. Now, again, like we said, you never know what kind of years you're going to get. We could get 2 or 3 years of real calm, and then, of course, we're going to get vol crush that takes it, maybe it splits in 18 months. We could get some ugliness. Maybe the market isn't going to recover so fast this time. Could take 4 or 5 years. But just on average, like I showed, decays about 1.2% per week, and you can go forward in time and you can see it. Now, the interesting thing about this and why I like to kind of run these experiments is, like I said, can we actually use this to capitalize on it? So we can go into Thinkorswim, and this is Thinkorswim from TD Ameritrade. This is what we use in our live streams. And we can go into what's called Think Back. Now, if I type in, Because remember, that live stream was on August 14th. So let's say the August 13th, 2021, one day before I made that prediction, which I nailed within 2 weeks, by the way. So that's a pretty good prediction. Let's say I actually bet money on that, and I went to the 20th of January. March is a little bit, yeah, I could do March actually. 17th of March, 2023. That's about right. So, oh no, those are the new ones. That's not going to work. This one here, let's do the January one. Okay, no problem. It's, yeah, of course, it's split adjusted. It wasn't earlier today, so that threw me off a little bit. But what happens if you actually made that prediction? I don't know if ThinkBack's going to work. This is not good, actually. I might have to scrap this whole experiment because this isn't going to show the accurate thing. It's going to take probably 3 or 4 days to accurately show what would have happened. I don't know. I mean, it's basically supposed to be break even. What is this? $872 on a, what is that? 4,100. So that's like a 20% profit, basically. For a 2-year trade, a 20% profit. It was down sometimes, and then it was up, and then it was down. Basically didn't make much at all, $510. Now, the point of this is that even if you nailed your prediction exactly, you still didn't profit on that trade. And I know some people are going to say, oh, well, what happens if you go way out of the money? Hopefully this is accurate. I can't guarantee that ThinkBack can do this in a single day, but it should kind of look the same or slightly worse, which this looks pretty accurate. So you can see down here, it's a negative number. So if you did an out of the money put option and you nailed your prediction exactly, right down to the month, the correct month that you knew that it was going to decay all the way down to that number, the more out of the money you get, of course, the worse it would have gotten. But the point is that you wouldn't have made any money. Now, a lot of people might look at that and say, wow, well, I mean, how can that be? We know that it's going to decay long term. I did a put option. It went from, that's all split adjusted and it looks a little odd, but it went from, say, 50 all the way down to 10 in the exact time frame that we thought it was going to do. Still didn't make any money. And so the takeaway here is, and this is something that I always tell people, the options market in the VXX, the UVXY, it is a relatively efficient market. Now, there's obviously going to be some retail traders who don't know what it is. They're trading. They never read the prospectus. They don't know that these products decay. They think they've found something really great. They saw a picture, oh, I'm just going to buy long-term put options. But the thing you have to understand is that most of the people trading there are sophisticated traders. Talking about volatility traders, number one. Number two, they're option traders within the volatility space. So this is largely sophisticated traders. Everybody already knows about the roll yield. They already know that it decays long term. They already know that it's at 50 now, and 2 years ago, it's very likely going to be at 10, give or take. Everybody knows this. This is not an edge. This is not a trading strategy. You're not going to make any money knowing that the VXX goes down. You can't just look at this chart. This is what so many people do. They just look at this chart and they think they've figured something out. Oh, I see. This thing goes down long term, so I can just buy long-term put options and I'm going to make a bunch of money, right? Or I can just short this thing and I'm going to make a bunch of money. It never works that way. If you're doing the put option thing, the premiums are obviously going to reflect the fact that that information is already disseminated. I've been writing about contango and roll yield and all these things for over 10 years. I'm not saying everybody's read my articles, but this stuff has been out there for over a decade. So that is not a strategy. You're going to actually have to need several layers above that of sophistication and understanding, and especially risk management, multiple layers of risk management, proper position sizing, and then you can make a bunch of money shorting volatility. I never discourage people from shorting vol. I think it's a great trade. It's probably my most profitable strategies, for the last 15 years. But again, low-hanging fruit. Just knowing that it goes down is not nearly enough to make money in this market. So as we proved, it's a good exercise to say, look, in 2025, what did we say, September 19th, 2025, if it is down at 10 and you buy a put option today, say a $15 put option, it's going to be priced at about $5. That's kind of how things work out. The options market's going to know that it's going to be roughly around 10. Not that they ran these numbers, but there's buyers and sellers here. Everybody knows about the roll yield. So Hopefully you have a little bit more sophistication than that. And then you can certainly make a bunch of money shorting vol. I always encourage that. No, definitely. One of these caught my eye. I'm going to do this. Let me blank that. How's the boat show? I went to the Dubai boat show. It's just like right behind me. It's Dubai Harbor's just, out this window. I was looking forward to it for a year. I actually came here specifically. I bought my tickets. I was ready to go. My wife wasn't supposed to be here in Dubai this trip, but I brought her out just for the boat show and a few games of golf. And it was pretty terrible, to be honest. They weren't letting us on the boats. The ones that I wanted to get on, specifically, what was that one that I really wanted to see? What's Ronaldo's boat? He's got the, why can't I think of the name? I mean, it's one of my favorite boats. I'm just totally blanked on a live stream. It's not the Sunseeker, of course. It's the Sunreef, of course. Sunreef 60 catamaran. I wanted to get on that thing, and the lady, I went up there. You have to sign your name and tell them that you're interested. And she took one look at me and she said, "I'm not going to show you this boat. We don't have time for you." And, I'm not one of those people that put my best watch on and, put on a nice shirt. I just went in shorts and t-shirt. And apparently that was a mistake because I got turned down by quite a few places. Just showing up looking like this, they didn't even want to show me the boats. So super, super disappointing. But anyway, live and learn. I probably should have pretended that I'm richer than I am just so I could get on a few of these boats. Pretty disappointing. I'll be better prepared next time. So let's move on to the community questions. There's a lot of them, so I apologize if I'm going to try to rip through these a little bit faster because I do want to give the live chat right now. I can see some questions in there. I want to make sure I get to those as well. So hopefully I'll give you good answers in quick succession here, but let's rip through. There's 14 of them. So we'll see. I might cut this short. I've got an eye on the time, and let's give it 15 minutes and then revisit. There's always some good questions submitted here. I'm sure that you're thinking of the same things. All right. One trading strategy you've mentioned is VIX straddles hedged by long out-of-the-money VIX calls. Yes, this is called my VIX options. Can you walk through that strategy? Time, entry, exits. No, I'm not punting on your question. Thanks, Steve. But that's actually going to be part of my course. I'm working diligently on putting together a course, and VIX options will be one of the initial modules. I'm working on a bunch of videos here. I'm going to put a much better job than I can obviously do on a live stream. So I'm working hard. It is coming. This is one of the original launch modules, and then there's going to be, of course, many more in the future. We've got tons of strategies, but I'll make sure that I give, 3 or 4 of the very best ones initially. And yes, I'm working super hard. So sorry, I need to punt on this one. I will explain it better in a course. All right, same Alexander asked about the boat show, I believe. What are your thoughts on shorting VX or VXM futures at certain threshold levels? Example, if contango and or daily roll reach certain levels, then short VX future. So the first thing that stands out, I do like that you said or daily roll. As I explained earlier, but I'll do it again, contango actually doesn't mean anything. The VIX futures are in contango right now. That doesn't mean anything. They can be strongly in contango, 5, 6, 8%, and still have negative roll yield. Remember, and you did mention it, you nailed it there, that you actually want to look at the daily roll, where as long as these two futures and the VX30, which is taking into account the number of days to expiration, as long as this is above the VIX, then you're looking at a potential, not guaranteed, of course, this is trading, but the potential for a tailwind for a short vol position. So I would say that's a good start. And then the rest of it, absolutely. This is the very early stages of a trading strategy. So this is fine. It's very preliminary. And to be honest, wouldn't take you more than a couple of cups of coffee and a spreadsheet in front of you. And you could actually do a back test and just run what that would look like. You could just say, what would it look like if I shorted VXX if the daily roll yield was 7% or more? What would that look like? What would it look like if it was 4? What would it look like if it was 12% or more? And you've already got the early stages of a trading strategy. And then you would just want to get more sophisticated, add other metrics into it. Of course, throw on some risk management there and some position sizing. But yeah, you could do all of this yourself. And within a week, but before next Friday's live stream, you could have a really good answer what are the appropriate levels based on roll yield? What would produce the best results going backwards? And then do you have a realistic expectation that that would continue going forward? Because of course, back tests are only a start. But yeah, you should run that yourself. That's fantastic. I like that. All right, here's a long one here. Can you walk through the specific mechanics of how you enter your stop limit orders, especially on Iron Condors? Okay, I already know the answer to this, but should I keep going? Your recommendation is to limit your loss at 50%, but on buybacks of short positions, I've had my stop limit filled because the market price of aggregate position apparently triggered my stop and then closed my position at a loss. I'm using TOS. So bottom line, the answer is I don't use stops, automatic stops on my trading. And you should never use market orders of any kind. Oh, wow. What's the market doing now? Down 1.5%. So this is an Iron Condor we have open. It's live. And I don't actually set the stop loss automatically. I just track my trades as it goes. So like you said, I do use a 50% stop loss. Here's the live trade here, right? Here's the current price right there. So it's getting into a loss territory. What I also do is I just keep basically one contract open that this isn't live, but this is just showing me what the premium is in the moment. And I know, let's say for easy math, that I sold this Iron Condor for $1.20. So if I use a 50% stop loss, that means times 1.5. If this hits $1.80, I need to close this trade. I just get out, take my capital, move the trade to a different spot. You know, no problem. Trades sometimes lose money, but that's how I manage it. I also use a 50% stop gain. So if this gets to 60 cents, I know that the price would be somewhere around here and it would be time to get out for the profit. That's all I do. But you will get into trouble for sure if you're using market orders, even stops, and you do everything correctly. You can still get in a position where, look, this is a 4-leg Iron Condor, and there's no guarantee that you're going to get an efficient fill price if you're using market orders. In fact, it's probably quite unlikely that you would. So I do everything manually. I just make sure that I know what trades I have open. This is why I always give a spreadsheet to everyone in the community. They can download the spreadsheet, and it's easy to just go through those pages, and you can see all the trades that you have on at a quick glance. And then just like I said, just leave one contract open, and you can watch them develop right here. When it hits $1.80, I'm going to be out. So unless it hits $1.80, you'll log into your trades in the morning. Here's today's email. You can see for the Iron Condors, there was no action taken, no new trade. We just left both of them on because I knew that when I was sending the email, it wasn't quite crossing that line. So that's how I do it, and that's how I'd recommend you do it. Never, ever use market orders for option trading. Probably don't use them for much of anything, to be honest. You never know. But certainly for options and multi-leg options, avoid that. All right, where are we at? Okay. Is there ever a scenario where you would prefer to make a short vol play on VXZ instead of VXX? Interesting wording here, so I'll answer this in two ways. Number one, you asked me if I would prefer it. I would prefer it 100% of the time. I would always prefer to use these, but I would never use them because VXZ has no volume, first of all. And secondly, if you're talking about shorting VXZ, it is an unlimited loss trade, and I just don't do those. If there's ever a flash crash or some type of cyber attack, you never know how bad things are going to get, so I never take unlimited loss trades anyway. So no, I would not do that. But you asked me would I prefer? Absolutely, I would prefer. And in fact, if I can find it here, UVXY TVIX, here's the ZIV. Remember, there was a product about 3 years ago. It actually delisted in July 2020. The ZIV was an inverse volatility ETF, or ETN, sorry, on the M4 to M7 VIX futures. So it was actually playing in this area over here instead of the front 2 months. And what this does, of course, it makes it a slower moving product. And it actually behaved really well. This was my favorite product before it was delisted. I wasn't literally crying, but I was, metaphorically crying my eyes out when this thing was delisted because this was a great product. But your question, would I ever do the same thing? This is the VXZ. Would I ever short this? No, I would not. I don't short any long volatility ETFs, and I don't trade things that have this low volume. So that's just a no-go. I would absolutely love it if a ZIV similar replacement came along. I would use it immediately. I would switch over for sure. It doesn't even have to be M4 to M7. Even I would take M2 to M4. That would be great. Just anything that gets away from the front 2 months, I think would be a benefit to the volatility community. Personally, I think somebody should probably launch that thing, give it a shot. I know that the first one didn't have huge volume, but what a great product. So yes, I would always prefer it, but I don't ever use the VXE. Unless I'm going long, then nothing wrong with going long VXE. Because it's a slower moving product, it actually is better behaved than VXX and certainly safer than UVXY. All right. Why IV percentile and IV current have different values on, so TWS is Trader Workstation at Interactive Brokers, and TOS is Thinkorswim at TD Ameritrade. If we don't have access to the VTS barometer, which one is more reliable? So I actually have to plead ignorance on this one. Now, my long-term portfolio is at Interactive Brokers. This is live capital. This is real money. But this is just our live stream account. My long-term portfolio is at IB because I get better commissions. It's just cheaper long-term for me to trade there. So one thing that might surprise you is I quite literally never use any analysis at all at Interactive Brokers. I've never even looked at, well, maybe not never. 10 years ago, maybe I did. But what I do is I have both of them open side by side. I will open my, I don't know if you can see it down there, but my Trader Workstation will be open as well. I'll do all my analysis here. Every trade that I'm planning to take will be done here. I'll look at the options. I'll plan everything out. I'll take the trades live for this account, for the live stream account, and then I will go into my IB and I will take the trades, again, the exact same trades, just in different size. Of course, the long-term portfolio will have many more contracts or shares, but it's the same trade. I do all the analysis here, and then I just hop over and I get the cheap commissions. So unfortunately, I have to plead ignorance on that. I don't know why that would be the case. But since I only use TOS for analysis, and I know that it's always good, and I've never had an issue with it, I guess the answer that I'll give you is TOS, because I just can't confirm or deny that the data isn't accurate on either one of these. I sure hope it's not on TOS. I've never had any issues though, so I think you're good to go there. I would stick to TOS. It's just much nicer, way more user-friendly. IB is the worst software in the world, but they do have good commissions. So, all right, how do you size your position with directional option trades? What option trades? That's a very broad statement. Most are willing to lose the entire premium, but I think there is a better way to do it. Again, super broad statement. I don't know what your portfolio looks like. I can't legally give you any personalized advice anyway, so I couldn't really answer this. But I would certainly have to know a lot more about your portfolio. There might be some situations where, I don't know, let's say you have a super net long portfolio, and then maybe that would make sense to take a reasonably convex large trade that you're willing to lose all the money, and then that would make sense. If you have a portfolio that's very neutral to the market, then yeah, it wouldn't make much sense to be able to lose all of your premium on a trade that is really not hedging anything useful in the rest of your portfolio. So of course, I would have to understand the beta to your portfolio and how it moves to the S&P. This is just unfortunately too general. I don't like to punt on any questions, but this one, you're going to have to give me more details. And I know you. We've spoken a lot before, so you can either email me or next Friday, I will try again if you give me more information. All right. Does it make sense to put in a stop gain order on the vol trend butterfly? It was doing well on Thursday morning, and I considered closing early, but didn't. Yeah, that happens. So I'll explain what's going on. We still have it open, by the way. This is the trade. And like he said, it was actually going pretty well. Let's move this out of the way. So here's the price all the way over here now. But actually yesterday morning, right? Early in the morning, it was right here. It was a perfect trade. It was going totally smoothly. And the question is, should we have closed it out early and taken the profit? For me personally, no. The way that these butterflies work, it's actually, they can typically make a lot more money than they can lose. These are extremely safe. That's why I love this strategy so much. It is short vol because we want, this is the VXX right here. So imagine which direction we want it to go. If we're shorting volatility, we want the VXX to go down this way, and we're short, right? So I'll actually set up another one that might give you this idea a little better. So this isn't a trade recommendation, of course, but let's say I typically do about 14 days, about 10 to 20 days. And remember, because of the reverse split, use the one that says 100. This will be the new pricing. You can see right there. So let's imagine that I did something like I don't know, how about a 52 butterfly? Again, I'm just doing this on the fly, so bear with me. This is not a trade recommendation. But 52, 54, and 50. So this is going to be a butterfly on the VXX with wow, look at that. That's just a wonky fill price. Don't worry about that. But here's the price right now. It's not a free trade, so don't go and rush and open this thing. But here it is right here, and you could even do a broken wing butterfly. You could do something like this, where of course, it would take an awful lot to go all the way down here, so we're risking nothing in this case. It would actually make money everywhere up here. It's profitable, so there's no volatility spike risk at all. And then we're basically just like, Wayne Gretzky would say, we're skating to where the puck is going to be, not where the puck currently is. Where the puck's going to be, the VXX is probably, if it has the normal decay factor, it's probably going to be somewhere down here in a couple of weeks. So that's how the strategy works. Now, it doesn't work very well to take 50% stops like your question was asking. What I would rather do, because of a butterfly, you want to wait until basically the last day. There's no harm in waiting till the last day and just trying to have more winners than losers and more winners that make more than the losers lose. So that's how you make your profit. A lot of singles. This is not a strategy that you're going to make a fortune on one single trade. This is something that we layer repeatedly over and over again. As long as it's advantageous, we have room for two, and these are short dated. These are 10 to 20 days. So we could do 3 or 4 of these in a month, and we could just layer them over and over and over again. And so they definitely work better leaving them to the last day. And like I said, with our live trade, the only time you'd ever actually have to do something to these is if one of the strikes was threatened. Because of course, with a option trade, anything that is in the money on expiration is going to be settled with shares, either long or short. And we certainly don't want to be long or short the VXX going through the weekend. That's not part of this strategy at all. So we would definitely close it out. But stop losses, no. I'm just hoping that, look, I'm not risking very much on this trade. I was hoping that it expired here. And if you wait until Thursday or Friday, the profit can actually be quite high here. Like this pink line, it was creeping pretty high already on Wednesday, and it would have been even higher. It's just one of those trades that didn't go well. Most of them work out pretty decent. Some of them don't. You can't control the market. What is it, down 4% in the last, not even 2 days, right? Because this all happened in the tail 2-3 hours of yesterday. So it's down a ton. The S&P is down 3.5% in, 10 trading hours. Pretty ugly stuff. But no, we don't use stops here. Iron Condors we do. Vol Trend Butterfly, just let them go. Don't ever let them expire in the money though. And I will always give trade instructions. Like if it was closer today, I would have said close out that leg. For sure, close out the 12, but it's not even going to be close. 12, 1-4 reverse split means 48. I think the price is in the mid 50s at this point. So there's basically, you can't say zero, but it's virtually 0% chance that it would get to 48 or below. That's just not going to happen. So nope, just let them go. All right. Will you go the ideal way to compound your total strategies? I don't understand that question. If you're asking me, do I compound my account? The answer is yes. The larger the dollar value gets, the larger my next trade will be. So if you'd imagine, let's say I had $100,000 in an account and I had a really good month. The next month I have $110,000. Well, the next trade that I take would be based on $110,000. So right now in our portfolio, we have 5 strategies with 20% allocations, each of them. Right now, it would be, with $100,000, you'd do $20,000 in each. But if I had a really good month and I had 110 the next month, then all of a sudden now you're doing 22,500 per strategy, and it's compounding. If I have a bad month, of course, it's less. But yes, I always compound. I don't know if this is your question, but I don't siphon anything off the top if I make money. I just let it go, and just long-term over time, absolutely, compound your account. We manage risk very well at VTS. That's really one of our focuses. So it's always better to compound. The only time that you really might consider not compounding your account, and again, math-wise, I'd have to know more specifically about your portfolio. So this isn't a blanket recommendation. But there are times if you've got extremely risky strategies on the table and you can lose large chunks of money at a specific time, then sometimes those things are better to just take a lump sum, a small portion of your portfolio, separate it from the rest of the portfolio, and just take those very risky trades. And every time you get a winner, you can take a little off the top. Because what we know about investing, of course, with geometric returns, the losses always punish you more than the gains help you. So if you lose 25%, that hurts you a lot more than making 25% helps you, right? The old, make 25, lose 25, you're not back to break even. You've lost money. So that's the only time. If you have a strategy that has a lot of very excessive wins and losses, maybe don't compound. But for me at VTS, risk management's top priority for us all the time. So we compound everything. I don't know if that's your question. If I totally missed, then please come back next week and ask again. 1048. How fast can I get through these? Okay, I'm going to go again. I tried today, March 9th, to exit the butterfly option position, and there is no bid price for the strategy. Interesting. I entered the market price and still I didn't get it done. In the TWS, there is a notification, basket derivatives restricted. Do you know why and what we should do? So there's two things that are coming to mind. The first thing I kind of just stumbled across here is when you're dealing with a fast moving market, remember I put up this trade and it's not free anymore. But when I showed you this before, like just 1 minute ago, it was trading at 1 cent. Now, obviously, you will never be able to actually exercise a butterfly that is a free trade, basically. You're risking 1 cent and you could potentially make this much. So you see it jumping around in a fast-moving market, and you got to understand the market, VXX is up 20% right now. What's the UVXY? The market is melting down as I'm doing this live stream. That is incredible. Fortunately, we're in, almost safety across the board, so I'm pretty calm here. But UVXY is up 30% right now. But in a fast-moving market, this is going to be all over the place. So that's probably one thing. You thought you were putting it at the bid, but that might not be the mid price. You might have to actually use your 30-second rule and chase it pretty far from what it actually looks like. That could be the first thing. The second thing is there was a reverse split done. So I don't know what your software or your broker deals with this, but it is possible that if you're trading this as a spread, remember there's a long and a short in a butterfly, your software might not know what you're trying to do. These options, the ones that are marked 25 out of 100 now, because these are, the old split prices, they don't want you trading these. So if you're opening a spread and you're trying to close it, maybe your software doesn't know what you're trying to do. And it's blocking you from doing the spread. And you would actually have to go into the individual legs and close those out. Sell to close, buy to close, sell to close. Now, again, I will stress, you don't have to do that. The VXX is miles away from where we would have to close this at this point. This is alarming. If this continues much further, the S&P 500 might take a visit on the lows recently. Where are we? Sorry, this is a side tangent, but I didn't realize the market was this ugly. We're not that far away from the lows. This is interesting stuff. Anyway, that's probably what's happening. Combination of the two things. You're trying to enter in a fast-moving market, which is just going to be difficult. So with our butterflies, you'll have much more success if you close the individual leg that might potentially be in the money and let the mid shorts and the long put, just leave those alone. If they're not going to be in the money, then don't touch those. You don't need to touch those. Just the ones that are in the money. And then, of course, your software might think that you're actually trying to open new trades on those options, which is not going to be possible. All right. Thoughts on using a position in UVIX, say 50% of short vol allocation rather than SVIX or delta 0.7 puts on VXX. Bid-ask spreads on VXX1 are quite wide today. Well, yeah, you can't do anything. If you're talking about VXX1, like the temporary bridge, where they're basically, they don't want to trade partial contracts because it screws up with the clearinghouse, yeah, you can't trade those. So just forget about the VXX1. That's just for if you happen to have trades open, you got to close those. But as far as UVIX, this is a 2 times long leveraged product. SVIX is a 1 times inverse product. And then delta 0.7 puts on VXX, this is what we typically do in one of our strategies. This is the weakest of the 3. So your question, would I use UVIX? No, because I would never short a long volatility ETF. That is an unlimited loss trade. And I bet you at some point in the next 5 years, people are going to know why I keep saying that over and over and over again. If there is some type of cyber attack on the New York Stock Exchange, I mean, God forbid, I'm not hoping that this happens. I'm just preparing for the fact that we always trade defined risk. So no, if that's what you mean, definitely no. If what you mean is UVIX options, that's also actually a no. Now, I'm surprised that the UVIX options didn't ramp up better than they have, but I just don't like the volume. I mean, look at this. This is the new string, or not the new string. This has nothing to do with VXX. This is not great. I mean, you can see the open interest, the volume for the day. There's nothing happening in those options. So unfortunately, there's really nothing we can do personally with UVIX. It is just it's part of the landscape. It's there. It's a replacement for the old TVIX. It's slightly different. It's definitely better than the old TVIX, but it is still 2 times leveraged, and it's way too risky. Both on the long side, if you get that wrong, if you get the timing wrong, you can get killed on the long UVIX. And on short, of course, this thing can terminate, right? So you're talking about something that is way too risky on either side of the equation. This 0.7 delta put VXX, this is much more my speed. And remember, I even like the ZIV, the old M4 to M7, which moved much slower. That's more my speed. This is essentially what we're doing with our tactical volatility strategy. We're trying to make the strategy pay us the money, not the added risk factor. What a lot of people do, and this, I've said it a million times, I'll say it again. There is a lot of people out there that are confusing a good strategy with just levered beta. All they're doing is just taking on exceptional risk, and sometimes it works out. And they think, wow, I've got a great strategy. What I like to do is make sure that I'm getting paid and rewarded for the strategy itself, not just matching I'll roll the dice on extra risk and hope it works out. I don't want that. I want a strategy that works for 15 years for all the right reasons. And that can easily be achieved at a 0.7 delta, at a ZIV slow-moving product. You do not need to use the UVXY, the UVIX. You don't need to short VXX or UVXY calls, undefined risk. These are just people who don't know what they're doing. They're basically trying to leverage their trades and then do this and hope they're lucky. They're not relying on the power of their strategy and the fact that I can hit singles over and over for 15 years. That's how I make my money. So no, hopefully I answered your question there, but no, this is my speed exactly. We like doing stock replacement, 100 days or longer, long dated VXX put options at about a 0.6, 0.7 delta. That's great. And then you can just rely on the timing of your metrics and making sure that you're short vol at the right times and you're out in cash at the right times. Then we can just ramp up the volume. No. Why would I want to keep some of my money on the sidelines? That's just, you've obviously recognized that it's too risky by even adding in the 50% stuff. So your intuition is telling you something's wrong there. I would just avoid it. Don't even use that. UVIX is, leave it for certain institutions that have certain minor uses for it, but it's basically a useless product. All right, before the VXX stock split, I purchased 4 call options for a 50 strike price for mid-June. So fairly long dated, seems like about 4 months. Since the reverse split, it is now VXX1 and worth 1 cent each. For a total of $4 in states, I lost 93%. Is this now worthless? Well, I mean, I can't see your account, but options themselves don't change value. So what could be happening is, I don't know how far out of the money you went. It's possible that you went so far out of the money that, let's say you were buying 15-cent calls, something like that, 20-cent calls. And those, because the market's moving around so fast today and it's actually up 20% and the mark is bouncing all over the place and your software is not going to keep up with that data. It's possible that it's showing you like it's one of those 0 to 5 cent options, but it's actually not. That's possible. I'm at a loss here. There's no reason why your option should lose value. Now, you definitely should close it. Absolutely. You can't leave a 4-month-long option open after a reverse split. So you have to close that and reestablish it for one of the newer ones, like I showed you. You got to get out of anything that says 25 over 100, and you got to get into something that says 100. So you said yours is for June. That's 98 days out. You could totally just use this one. It won't take more than a day or two before the volume comes back. You can see already some pretty big bids are up here. 1680, that's, volume. 1,100 contracts, 550. These are today. This is, open interest today. So I don't know. Boy, that's alarming. I have to admit, that's surprising. Your data shouldn't be that off, but you need to call your broker and you need to ask, because as I went through with my presentation, no actual value has changed. But then again, these are options. You never know if it's just showing you a terrible print. I would absolutely get to the bottom of that, because there's no way that you should have lost money just because of a reverse split. It doesn't work that way. What effect on the current butterfly strategy? I assume you mean the reverse split. What effect? None. We're so far out of the money, it didn't matter. If it was in the money, like let's say the market behaved normally, to answer your question, what would have happened is we would have closed this leg for sure. And then if this one was potentially in the money, we could have closed that one as well. But we just close based on need only. If it's only going to be a 1 penny strike and there's no way it's going to be in the money, then don't even waste your time. It's just more efficient to close the in the money ones. Prediction for date of UVXY. For that, I would rather leave it. Like we said, we have predicted the next reverse split on the VXX to be September 10th. That's not right. We added 9 trading days, didn't we? Actually, we said September 20th. September 20th, 2000. Come on, typing. What's wrong with my fingers? September 20th, 2025. We'll save the UVXY for next time. I think those are fun on the live stream. It only took 5 minutes, but pretty cool to go through those. So yeah, let's punt on your question as well, and we'll do it for next time. Because UVXY, I don't know why it gets more interest than VXX. I find, 90% of your short vol trading, I don't want to say should, because everybody's got their own strategy, and there's many ways to make money. Mine's obviously very far from the only way. But you really can do all of your trading on VXX. I'm not sure why UVXY gets so much love. It's riskier, right? Why? Like I was saying before, it was a little bit of a rant, but there is some truth to it, that you really want your strategy to be consistent for a decade, don't you? You don't just want to take advantage of everything good, and then on a day like today, look, if you're at 1.5 times leveraged and you're short, today hurts badly. It's 30% down. If you're in the options, you could be down way more than 30%, right? A short call on the UVXY, it's not down 30% when the UVXY is down. It's down hundreds sometimes. Why put yourself through that? The losses always hurt you more than the gains help you. You cannot escape the math. Look, it's such a simple example, but let's just do it anyway. You have $10,000. You make 50%. Now you have $15,000. Now you lose 50%. Now you have $7,500. You are not break even. You have lost 25% of your money. This is the math of taking trading losses. You need to avoid excessive losses, outsized losses, more than you need to chase the wins. That is just basic math. This is investing 101. You always maximize your profit by reducing your losses. That's how you maximize your profit. But for some reason, everybody's brain is programmed to chase the wins, to get those victories, to put on the risk and see if it works out. Just mathematically, if you just want to have a good 20 years of investing, manage your risk. Do that first, then figure out the rest later. So I just don't get the whole UVXY. Sometimes people get almost offended that I talk about VXX on Twitter. They're like, why are you talking about that stupid product? What about UVXY? What about UVIX? Stop it. Learn how to make money on the small ones and then ramp it up later on. There's lots of time. Look, unless you're 79 years old, I'm assuming you've probably got a few years of investing ahead of you. Learn how to be consistent first. You don't need to chase all the time. So anyway, use the products you want. Like I said, there's many ways to short vol. Mine's not the only one. But boy, people love to chase risk, don't they? Hardly ever works out. Funny how that goes. Most traders lose money and they don't understand that it might not even be because you're not a good investor. It might simply be that you're giving money away on the basic math equation, the risk-reward equation. Your strategy might be actually decent, but you can't beat the math. If you're taking the odd 20, 30% loss, that's so punishing. If you can keep your losses to 10% and your wins to 5% and just rinse repeat with high frequency, that's where the sweet spot is. All right. I hold in the money old VXX put options, now named VXX1, under IB broker. In case I keep them for expiration due to poor spreads, will I be assigned with the new VXX with quarter the amount? So you've got in the money and you're not planning to close them, right? If you're not, there's just no way that you're going to have to adjust anything down the road, and you are okay with taking assignment, then yes, you can just leave those. But if you are anticipating at all having to do anything, the longer you wait, this is just going to be bad. So what I always, look, no value was lost. Unfortunately, today's not a great day to do a live stream because the VXX is up 20% and the option prices, I'm sure, are going all over the place. So people are having this issue like, what is going on? I'm losing value. You're probably not. That's not how reverse splits work. But it appears that way because the data right now is probably going bonkers with UVXY up 30%. But no, you didn't lose anything. So if it was a flat day, like on Monday, let's say the market's flat and calm and you can see the bid ask and the mid price and you know you can get out, is there anything wrong with just getting out and reestablishing the same position? No value was lost. So I never should say don't. But today might not be the best day to do that. You might get, like you said, poor spreads today. But I just always say, if you see the split coming, follow me on Twitter, @VolatilityVix. Let me put up my, which one can I do? Segments. I guess I could do this one. Or no, default scene. Follow me on Twitter. You'll be aware that the splits are happening. I'll probably announce we're doing a live stream and we're going to calculate a bunch of cool stuff. And you're going to know, okay, well, that's the signal. Okay, I have to close my options. I have to reestablish new ones. Just do that. Just get into the habit of doing that. And then none of this will matter. Reverse splits they should be a real non-issue. Like it shouldn't even be anything that we're talking about. But it's actually pretty interesting stuff, so I still will. But no, just always reestablish, especially long-term. Why bother holding the old ones? There's nothing there anymore. All right, if increased volatility works against an Iron Condor position, yes, because it's a short Vega position. So if volatility goes up, it hurts. Why did you open a new position Monday, knowing we had NFP, CPI, OPEX, and the Open Market Committee upcoming? It was logical to assume, okay, I know your question. Because I don't take macro into account for my trading. There's so many things in the market that could potentially, in air quotes, if you're just listening, potentially affect a trade, right? There's a million things in the market that could affect a trade. You can't take them all into account. So you have to focus on your area of expertise. And for me, I'm a volatility guy. I analyze the volatility markets. I don't take into account, well, boy, maybe I shouldn't open an Iron Condor because volatility is going to rise this week into the NF. Maybe it didn't. go through history, there's plenty of times where those are just complete non-issues and nothing happens. The market doesn't even really price it in. Who cares? Those events are nothing. I don't think what's happening now has anything to do with those events. The only time that you might have a case is if it was a super binary event that was really like remember back in the Donald Trump election, that was a real thing. I actually closed trades out. I overrode some of my strategies and closed trades out. These are big, big market moving events. But things that happen on a regular schedule like that, no, you can't take minor macro events into trading. Right now is considered reasonably good time to open an Iron Condor. And don't be surprised if we open another one early next week. This is, you want mid to high volatility. But what you don't want to do is start using your predictive nature. Like, oh, maybe I think it's going to be even higher on Friday, so I'll wait. Well, maybe it's not, and then you just missed your window. So I just opened the trade, and it's still open as of today. No new trades. Same person. In such a situation, wouldn't it be wise to spread our purchase 1.5% on Monday and then the other 1.5% later? No, I don't do stuff like this. We open an Iron Condor because within our portfolio, we have plenty of directional exposure, right? We've got defensive rotation, plenty of if the markets are doing well, our 2 times NASDAQ is going to be just fine, right? Our tactical balanced is also plenty of directional exposure, strategic tail risk. We've got this S&P 500. The reason we opened the vol trend, which is the UVXY or VXX Butterflies, and the Iron Condors, is they're more neutral. We're just trying to fill in that hole in our portfolio that very few people out there have market neutral exposure where they can actually make a profit when the markets don't do anything, right? You should know that, because you're in the community, that in 2022, the Iron Condor strategy made 26%. In this year, in this, you're looking at 2022, this mess, the Iron Condor strategy made 26% because it's market neutral. It's got a long way to go. Just because it shoots up like this doesn't mean it's going to breach the actual wings of an Iron Condor, which are very, very wide. So I didn't take into account any macro events along here. I didn't care when the Fed was meeting. I didn't care about any of that. Only if it's a super major binary event would I ever consider something like that. Like the Brexit, for example. I shut down for 1 day. I didn't hold positions on that Brexit day because bad things could happen, and bad things did happen that day. So, but otherwise, no. You can't take everything into account. You have to focus on 4 or 5 areas of expertise, and we don't take gamma exposure into account. I don't do any technical analysis. I don't take any macro in. We don't do any seasonality. None of those things. We're volatility specific. Everything we need to know is going to be screaming at us with the volatility metrics that we track. Okay, one trading strategy you've mentioned in VIX. Oh, you asked that already. Yeah, Steve, I'll get to it in a very detailed course, I promise you. What is the median amount of days between all-time highs in your portfolio? Interesting question. I don't have the data, but I could take a stab at it. What is the median amount of days between all-time highs? How about we start with let me try to, I don't know if it's on the website yet. I haven't updated. I think I updated it. The website should be updated every month, but sometimes I have 10 projects on the go at the same time. So you can kind of ballpark it, and we can take a guess here. Of course, 2022, it wasn't really the whole year. It was just the first 3 months of 2022 was pretty rough for the market. And so that took us down. And it's been decent, the last 7-8 months. It's been fine. But that might take a while to recover from. I can't say for sure. Previous periods that were not fun, of course, I lost, I think, 7.5% in March of 2012. And that probably took 3 months to recover from. And then this one, I do remember this one vividly. The way that it worked out, you can't really see it on this chart. Can I go bigger? But This right there is actually, I think, 0.02% below. So this counts as a drawdown the whole way, even though it kind of recovered and it's basically the same. It's technically a drawdown for like 8 months, I believe, something like that. I'm just going by memory here. So median amount of time. Bottom line, it doesn't take very long. But of course, 2022 was a really odd year where, as we talked about it a lot, you had a situation where stocks crashed with very low volatility. So there was very little to push us into safety. And then when we did go into safety, the safety positions themselves also crashed, right? The bond market was down, the TLT was down 31%. The IYR, the real estate ETF, that usually does way better than stocks in a crash, that was down. Utilities were down. Gold was down. Everything was down. So it was just an odd year. There was no safety to move to. So that drawdown, who knows? It's going to affect the median. But I would say most of the time, we are typically almost always within striking distance of all-time highs. That's just kind of how my portfolio, because it's so diversified, if I could just do the whole minus 2022 thing, which of course it counts, that is a loss. I'm not making excuses. I took those trades. I moved into safety, and the safety positions failed us. It is what it is. But if we could just remove that one part, then I would say, yeah, it's within a month, 2 months. We're always within striking distance of all-time highs. Because if the portfolio of trend following is not doing great, then that probably means Iron Condors are doing very well. That probably means volatility trend is doing quite well. That's how I trade. You get a year like that, which is kind of certainly blindsided me. I don't know, probably most of you watching, but if you did better than me, congratulations. 2022, from January until about April, was brutal. It was really, really tough. We've never seen a market like that before. Safety positions and volatility signals have never really muted like that before. So I hope this doesn't affect our long-term median. Where's your question? But I suspect, yeah, it will. Let's say I've been doing this now for over 11 years. Let's say 10 of the 11 years, we're almost always near all-time high. One of the years, we're still clawing our way back. And we'll see how long it takes. I don't know. Hopefully not too long. Hopefully our market neutral strategies can get us through this, because the market's clearly not ready to recover. We're seeing that now, that this is not going to be one of those, COVID things where it's at all-time highs and, a couple months later. It's not happening. We've been in a drawdown in the S&P for a while, and it could, not to be doom and gloom, but if we go into a recession, I mean, how long? It could be years. It really could be years when the S&P 500 is in a drawdown. I don't want to see it because a lot of people are net long the market, and they're going to be hurting for a number of years. But ramp up your option trading, ramp up your market neutral strategies. Shameless plug, join the VTS community, take the Iron Condor course. There's about 25 videos there. That, I suspect, is going to be a strategy that is very valuable in many people's portfolio for the next few years. I don't think net long market trend following is going to do that well, to be honest. So this is weird. Who pays the returns your strategy achieves above market return? First, you'd have to define what market return is. There's many markets, right? Market in quotes. What is market return? Secondly, I think you're implying that some type of zero-sum thing here, where if I make money, then who's the one on the other, who's my counterparty losing money, something like that. The markets don't work that way, because a large chunk of what we do is options trading, and options trading is not a zero-sum game. There's market makers that they're facilitating the entire market and intentionally trying not to take any directional exposure. So there isn't some, like when I take an Iron Condor trade, some people have this image that there's another dude on the other side of my trade taking the mirror of my trade. That's not how it works. The options are just thrown into a big pool, and they're all in there, and then the brokers and the computers just match up contracts. If I do a short Iron Condor, there isn't a guy on the long side of that Iron Condor out there, playing against me and hoping that their long Iron Condor makes money so mine doesn't. It has nothing to do with that. The markets are, from our perspective, they're not zero sum. There are a lot of players in the market that are creating liquidity and doing certain things that are not directionally exposed. They're hedging elsewhere, and the positions that you are the counterparty of, you're not really the counterparty because they're counterparty somewhere else. It's not a good way to view the markets. We want to make money. I might have totally misunderstood what you're saying here, by the way, too. So, but yeah, I don't really understand that. We're always trying to make money, and we doesn't necessarily mean we're taking somebody else's. Nobody's paying anything. Just if you're smart, you'll make some money. Okay, how long have we been going? All right, please walk through the specific mechanics of how you've already asked that too. Okay. What are your thoughts on SVOL? I'm going to get to SVOL because I don't understand. Has SVOL done a serious ramp up in their marketing lately? Because my email inbox pretty much every day now is SVOL, like questions on SVOL. The thing about SVOL is we did a live stream last week talking about dividends, and I explained quite clearly that when dividends are paid, nothing happened. You didn't make any money. Now, that's not necessarily true with SVOL because these are distributions of the profit. But if in order to see the actual return of SVOL, you have to back out those dividends, right? And so when you compare something like SVOL, which is paying out distributions, and you compare that to something like SVXY, for example, SVXY is just better. I mean, it just is. And it's not even our top favorite way to trade vol, but it's just better. Plus, I want to be my own risk manager. I want to make sure that I'm either in the product or I'm out into safety. I don't want to rely on the fact that they have a certain percentage of undefined long calls protecting the portfolio. And why would I trust somebody else to be the risk manager when they're not sharing anything? I have no idea what that means on their end, and we don't even know if it's going to work. We haven't really seen it in action. We just know that through this period where it has been a very short lifespan, it hasn't done particularly well. So I don't know. I don't understand what the attraction there is. If dividends themselves don't make you any money, because of course the price of the ETF gets deducted by the dividend that gets paid. So SVOL, when dividend day comes, you didn't increase your net worth at all. It's just something that goes down over time because those dividends are being removed from the NAV value. So I don't like it. I would much rather just implement my own short volatility strategy. I don't like these dynamic funds where somebody else is doing something, right? I'll do the something, right? I'll do that for myself. And like I said, being in cash is a major part of my strategies. I don't like the idea of constant exposure to short vol and then trying to waste money with hedges. Hedging is not cheap and it's not easy, and it can fail. You can get the calibration wrong where sometimes you hedge too much and it really cost you, and other times you hedge too little and you thought you'd be protected in a crash and you didn't hedge enough and you weren't protected. Hedging is not easy. It's just easier to say, look, 50% of the time I'm going to be in cash. 50% of the highest volatility times I'm going to be in cash. Don't even worry about hedging. Why bother, right? Just sit on the sidelines and wait for a strong trend downward. All right, I think we're almost done. Here we go. What do you think of adding a short 30 delta call to your long VXX 70 delta put to 100% stock replacement? Adding a short 30 delta call. Nope, I would not do that. Why? Because now you're basically, you could view that as a ultra risky covered call basically on the position. You're trying to collect a little bit of premium there, thinking that the main trade's going to be right and you're going to bring in some more. But now you've introduced a risk factor to it, that a short 30 delta call, I don't want that. That's not part of the strategy. I don't want to take that risk. No, definitely not. I would separate the two. I would never do the short 30 delta call. As you know, I explained that, I don't take that type of risk. But if you're going to do that, I don't see why these two are connected. You should maybe separate those and add some layers of risk management for both of them. But it sounds like you're trying to manage the risk on the 70 delta puts, the long 70 delta puts, Well, that requires convexity on the other side of it. Pulling in short premium is not a hedge. And especially in the volatility space, that's not a hedge. It does nothing, right? It blows right past that, and what you thought was going to bring in a little bit of extra money is now costing you a fortune. So I'd separate those and try to make them both safer rather than just introducing random risk for no real reason. But again, I should reiterate that that's just my opinion. It doesn't mean that you couldn't make this work. This is just not something that my portfolio would touch. You go ahead and take your risk if you want it. Bid asks will only quickly continue to widen. Yeah, they will. That's just typically what happens when there's no incentive for the market makers to be focusing on these options anymore. So they just kind of, graveyard, they're ghost town. So why hold them when you don't really have to? As long as you're doing it very close to the date, no value's lost, as long as it's not a super fast moving market day as well. Like today is not great. But always, just best practices. Just get out of the old ones, get your trade into the new ones. You can always transfer it over with no loss, especially if you know ahead of time. If you follow the right people on Twitter, you're going to be notified when these splits are happening, and you're just going to immediately get out and reestablish a materially identical position with a better, the market makers actually doing their job with the new string. No downside. I don't know why people try to prolong and extend this. Can I hold this one? What's going to happen if I hold it? Just don't, right? You don't have to do that. You could just get out and get into a new one. Okay, I was mainly looking at how SVOL with drip has done a return of 9%. True, but you are measuring against the wrong underlying. You're measuring against SPY, and short volatility ETFs should never be measured against the S&P. They're totally disconnected. What I think you should be measuring against is something like SVXY, especially since SVXY is a 0.5 time product now. It's actually quite close. I think SVOL targets about 0.25 constant exposure, and then they're doing some, hedging and whatnot like that. But measure it against SVXY, and it'll start to look a lot worse. And then when you factor in that you could have just exited to cash completely, right? A day like today, there would be no reason to even be in short vol to have this devastation happening. Because if you're short vol only, say, 50% of the time, you're long vol maybe 5% of the time, and you're in cash 45% of the time, well, look at where the volatility metrics were as of yesterday. You wouldn't have even been in a trade today. You wouldn't have been short vol today. You would have been out in cash if you were your own risk manager. If you allow them to do it, they're going to hold constant exposure to short vol. It's not actually it's a good exercise. Why don't we check? It's probably down a lot less than SVXY, but it's okay. So it's down 3%, and SVXY is probably 7 to 3. So that makes sense. So their hedging accounted for, because I think SVOL is targeting 0.25. So it should be half, so 3 to 6. I think their hedge saved them about 1.5%, it looks like, just on first glance. I don't know. I would just prefer to be out. Like I wouldn't have been in that trade today. My tactical volatility strategy was in cash as of today. So again, there's more ways to make money than just mine. It's just, in my opinion, SVOL doesn't do anything for me. I have no use for it. It's not designed for me, so that's maybe not saying much. I actually do know how to trade volatility, so I don't need them to trade it for me and manage the risk. If you do, if you really don't know what you're doing with shorting vol, and you really do need that management team telling you, okay, this is the constant exposure, and then this is how we're going to hedge it. Okay, maybe. What I'm going to do is I'm going to put together a volatility landscape video course, basically maybe 10 or 12 short-ish videos. What is UVXY? What is VXX? What is SVOL? And just explain them basically to people. And SVOL will be on there because it is in the volatility landscape. It's just nothing that I would use. I don't like dynamic products. Again, I am my own risk manager. I don't need somebody else managing it for me. Okay, I appreciate your thoughts and certainly agree with accounts I don't mind trading myself. That's a follow-up to the SVOL stuff. Yeah, if you know what you're doing, then I think you're probably just better off designing your own strategies. Just logged in and saw a VIX spike. Is it time for short volatility trades? All right, let's end on this. That's super vague, so I can't really say anything. But what I can say is that being a contrarian is typically not the way to go. So when you get a VIX spike, in general, and I understand that there's a lot of strategies that if you have a small portion of your portfolio, you might be looking to establish short volatility positions on those spikes. So that sounds like what you're getting at here, that, you know, if the VIX is up that high, if the VXX is up this high today, maybe now is the time. What you also have to know, though, if you're talking about a serious strategy with a reasonable allocation in your portfolio, the most dangerous times to short volatility are when volatility is going up. That is the most dangerous time because it's a very short trip for the VIX to go from 27 to something in the 40s. And if you're in the habit of trying to short volatility every time you think you've seen one of these peaks, well, then what happens if you extend it further? What happens if you thought you were shorting volatility during COVID and you thought, oh, there's a giant VIX spike, I'm going to short there. Well, that didn't work. Now it's certainly too high, right? Now it's all the way up to 30. Now I'm just going to use a little bit of extra capital and I'm going to short a little bit more. I'm going to defend the position. I'm going to add a little bit more and certainly it's going to fade back. Well, nope, that didn't work. Now it's all the way up here. Now I have to do it again. Oh, that didn't work. Now it's all the way up here. You see what's happening. You're shorting volatility at the worst possible time. So like I said, if you're talking about a small percent, like just a little vertical spread or something like that, a 3-5% vertical spread, okay, typically volatility spikes will be faded, right? So you're not wrong that, okay, it spikes up, maybe I should establish something. But if you're talking about a significant portion of your portfolio, right now, it might sound a little weird, but right now is when I'm starting to look for interesting long volatility trades, right? My volatility barometer hit 75.5%, I think, today. Let's get the exact number. It hit 75.85. Something interesting, it rarely gets this high, but trend following in volatility is more profitable long term. So what I mean by that, we have a strategic tail risk strategy. If it hits 80%, I actually go long volatility. We're not shorting volatility on this spike to fade it. We're actually going long volatility to capitalize on the possibility that, you know, Monday or Tuesday could be a ugly day. That's how volatility happens. It typically fades and then sometimes it gets, you know, hammered upwards way, way faster. So I actually establish more trend following. The problem with what you're doing, shorting, is that if you're wrong, you had to leave capital on the sidelines to defend against it, which means every time you're right, it's going to be on a small portion of your portfolio, right? It's not really going to impact very much when you're right because these are just tiny little trades. All of the levels that you left off to the side so you could defend it in case you're wrong, those don't get allocated unless you're in real big trouble. So you're designing a strategy that you're being a volatility contrarian where all of your winning trades, and there will be several of them, because if you're selling out of the money premium, more often than not, it's going to fade. All of your winning trades are going to be on small portions of your portfolio. And all of your bad trades are going to be when you're ramping up your capital. So you're punishing yourself huge when you're wrong, and you're not rewarding yourself hardly at all when you're right. That's the problem with risky strategies. It's the same problem I've been saying for a decade now, shorting calls on the UVXY. This, for some reason, sounds like a good idea for people, but I will say it again. The only way to make that strategy work is if you reserve a massive amount of capital on the sidelines to defend that position. Typically, at least 4 or 5 times the capital has to be in cash on the sidelines, ready when you're wrong, because you will be wrong one day. And trust me, 5 times is not nearly enough. I've got a video planned. 10 times is not enough. There have been times in the past where reserving 10 times your capital, you would have gone bankrupt anyway. But imagine what's happening. You're going to get a whole bunch of easy wins on 1/5 of your money. And then every time it goes against you and you're totally wrong and you get a COVID or a Volpocalypse or a, 2022, every time you're wrong, it's going to be costly and you're going to get all your capital wrong. Every time you're right, tiny wins. This is not a good risk reward profile. This is something that I suppose it sounds good on Twitter because people don't actually report performance on Twitter. They only report win rate on Twitter. They say, oh, another max profit Friday. Look at me. Short UVXY calls, expired worthless again, easy money. They're pulling it in every week on Twitter. They're telling you, I'm just winning week after week. This is unbelievable. I'm on a 10-week win streak. What they don't tell you is that's 1/5 of your money and you're pulling in pennies on those short calls. You're pulling in pennies on 1/5 of your money. Congratulations. You're not putting a dent in your overall portfolio. But when it blows up in your face, that's when you're going to have all your capital exposed. And that's when it's going to start to bleed down. So this is what I call a Twitter strategy. When people try to fade vol, they're not really counting the actual performance. It doesn't add up to a very impressive rate of return. What you want to do when you're shorting volatility is you want to get the maximum amount of capital to work as possible in the safest possible way so that when you are getting your wins, it's helping push your portfolio forward. You need to be doing that. We get 20% of our capital working for the short vol. I don't want to divide it up and leave 4/5 of it on the sidelines and get 8 easy wins in a row that only made me 0.3% on my overall portfolio. That makes no sense to me. I want to get my 20% working. That's why I use butterflies, because when I'm wrong, and we are wrong sometimes, we lose more than we win. There is no upside risk on a butterfly. If it spikes to 1,000, we don't lose any extra money. We lose 20 cents. Who cares, right? So that's how we're making our money. We're exposing a lot of our capital at the same time. These Twitter strategies that relying on extremely high win rate because you're selling the wings or you're selling way out of the money calls. Oh, it'll never get there. It'll never get there. We're just going to get 20 weeks in a row where I get to go on Twitter and tell everybody it's a max profit Friday. Okay. You're not making any money doing that. You're just getting followers on Twitter. More people are hitting the blue follow button, but your portfolio is not growing in capital because you only had 2% of your money allocated to that trade. It doesn't matter if it works out. You sell a 30-cent UVXY call on 1/15 of your money. Awesome. Good strategy. You can tell I'm getting a little bit triggered when I talk about this because I see the same 5 or 6 people talking about the same stupid strategies over and over on Twitter. I watch their following grow, and I guarantee you their own portfolio is not growing because I know what they're doing. They're relying on high win rates. They're relying on churning weekly trades that sound like they're just money falls from the sky. ATM machine, right? No, it's not. It's only an ATM machine if you have large amounts of your capital exposed to the winning trades. It's not an ATM machine if it's picking up pennies. It's just pennies. So a win's a win, but I would rather have a win that actually impacts my portfolio, which means I do have to manage my risk exceptionally well because I have a lot of money exposed. I want to make sure that when I'm winning, I'm actually winning. So that is a long rant. I know that's not exactly what you asked, but I hope somewhere in that 5-minute rant, I answered your question. Fading vol as a contrarian, it's just picking up little pennies. It's not something that's going to sustain long-term portfolio growth. I would do the standard. Best time to short vol is when vol is low. Best time to go long vol is when vol is high. Just for large portions of your capital. If contrarian, you can do what you want, but trend following is much more reliable. You don't want to be a contrarian for 15 years. It's just not sustainable. So, all right. We went long, of course. That's my style. We went long. But a lot of good questions. Thank you, everybody. And, of course, come back next week. I don't know what we'll talk about, but we'll do a data corner again. I think people like those. And maybe something I'm planning. I'd like to show people where short vol makes the most money. So what I might do is just run some numbers, just divide the VIX into deciles maybe, and show everybody how much short vol actually made during that decile of pricing. I think that might be interesting. Because a lot of people, and it might answer actually this fading question, where does the short vol trade make the most money? when is the best time to be short vol? Is it when the VIX is really high? Is it when the VIX is really low? I can actually just run the numbers for everybody, and that might be a good one for next week. So tune in, of course, ask your questions, and have a good day.